Hello, everyone. Welcome. Thank you for joining today for our webinar. We'll be going on scaling your business legal and tax considerations. My name is Connor Spencer. I am the team lead of our legal and accounting solutions, and I'll be your host today. If you are discovering us for the first time, basically at Lawpath, our mission is to empower businesses to succeed by making complex legal and tax matters simple, accessible, and manageable. So we offer a seamless platform. It's got a built-in adaptive contract builder. It's got some AI tools where they can help you create legal documents, can help you manage compliance, and most importantly, connect you with on-demand legal and accounting support, all tailored for small and growing businesses. So we provide, first of all, access to our senior commercial lawyers to make sure you both meet and understand your legal obligations, but to also make smarter business decisions from that legal standpoint. So whether that's, for example, in the form of adapting your contracts and documents through advice on a contract review, or getting advice to ensure, obviously, your specific business interests are protected. Likewise, we provide access to our senior chartered accountants and tax agents to make sure you both meet and understand your tax obligations, but to also make sure you make smarter financial decisions under the advice of our expert accounting team. And we provide all this and more through our standalone legal advice and accounting advice subscriptions, or you can bundle these together. There's lots of crossover whereby having a lawyer or having an accountant together to advise you on a particular matter can be hugely advantaged. So, like a couple of examples that might be in regards to your business structure and restructure, capital raising, protecting your IP, advice. Obviously, your business, legal and accounting is then all under one roof. So not only can you get advice you need, but you can also maximize the return and investment of it. So we are 10 years in the game now. We've assisted with 500,000 businesses, which is a milestone we reached very recently. And we've also saved small businesses over 500 million in legal fees. And not quite there yet, but we are very on track by the end of this calendar year to hit nearly 15,000 yearly subscribers to our legal and accounting plans. So in today's session, we will dive into key considerations for scaling your business successfully. We're excited to have both Damin Murdock, our principal lawyer, and Tim Quinn, head of tax and accounting at Lawpath, sharing their expertise on essential topics. So as mentioned, having both legal and accounting perspectives is key in building a solid foundation. We'll go through some of Damon's legal insights and Tim's accounting strategies to leave you equipped with the foundational knowledge needed to make informed decision about your growth. So we'll explore a few important aspects like business structures, whether you're planning or considering a trust, holding company, maybe a multi-entity structure. We'll look at the right setup that you can do to protect your assets and improve tax efficiency. Contract reviews, absolutely, even if you're on your day zero of your business, but especially if you are going through growth as your business partnerships and client relationships become more complex, keeping those contracts aligned is critical. And capital and budgeting from planning to investment, managing budgets and cash flow. We'll cover just the essentials there to ensure the financial health as you scale. And as always, guys, please don't rely on a 45-minute webinar to serve as the bedrock of your legal and accounting decisions for your business. Always aim to get specific tailored advice to your business so that you can protect it and ensure its success. We will, as you can see, have a Q&A at the end of the webinar. So pop your questions in that Q&A chat box, and yes, before anyone asks, we will be sending out the slides and recording either later this evening or by tomorrow. So without further ado, I believe you're up first, Tim. We're starting off with you.
Lucky me. Thanks very much, Connor. We're jumping straight into it, aren't we? There's no pitter patter on this. We're straight into business structuring. Fantastic. What do we mean when we're talking about business structures? Anyone can go out there using the Lawpath platform, very, very simply start up a company. It's our bread and butter. We all know how to do it. You can have two shareholders, $2. That's a business structure, and that's a business structure that works pretty well for everyone. It's as soon as you corporatize, you take on this proprietary limited, you get this veil of corporate personhood that is a fantastic way of protecting yourself from liability. Doesn't do everything for you. It's from a tax perspective, there's more left on the table. You can get a little bit more complicated, and that's when we start talking about things like a dual company structure. So that's something that you will see very often in certainly in our Lawpath customers as they grow, as they become more complex. The addition of this holding company and a subsidiary or an operating company underneath becomes more and more common. Why do we do this? It's not to create more accounting fees, although that is obviously an unfortunate side effect of that. But why do we do it? Is it becomes more scalable. When we talk about scaling up, we often realize that we can't go it alone. When we're growing businesses, we often need to get investors in. Having this dual structure and allowing you to replicate the operating companies for everything you do means that you can just attract investment into the holding company at the top, and have protection. Well, we'll have basically access to the equity of all of those companies by virtue of that structure. Creating an extra company doesn't need to create more tax returns. We can do what's called tax consolidation, to basically minimize the compliance cost of this going forward. And as I mentioned, it's easy to replicate. Once you've got a holding company and an operating company, for reasons that Damin will probably talk to later, you might want to get a new operating company or a specific intellectual property holding company, and it's very easy to replicate within this structure. Connor, we might move on. Even better, if you have this holding company and trading company agreement, if right up the top, rather than having it owned by what we like to call a mum and dad proprietary limited company owned by shareholders, the shareholder we will often have as a family trust. And we'll talk to trusts a little bit more later in the slides. But for anyone that's been on these slides with me, these webinars with me before, they'll know I refer to this as basically the golden structure for a lot of fantastic asset protection and tax minimization
Yeah,
reason.
I might jump in there a little bit,
Thanks,
Tim.
Sam.
These kind of structures, they're great, but there's pros and there's cons. So it's definitely not for everybody. You don't want to go in and overstructure your business all the time because you're going to have that increased in accounting costs. And it just might not be necessary based on the nature of what you're doing. But when we look at tech startups and things like that, we normally recommend the holding company and trading company structure. And the main reason for that is that if you're a big, fast growing, scale up tech company, you're probably going to get possibly millions of dollars into your bank account. And if you're just a trading company, those millions of dollars are sitting in your trading bank account. And if your company ever gets sued, all your investor money is now accessible by anyone that sues you. So we oftentimes say, well, to protect your own investors' money, you want to have first a holding company where all the investor money goes in, and then your holding company can then lend the money to your trading company, be the first ranking secured creditor against the trading company, so that if anything does happen, the holding company can go and claw back its money. Or it might be your tech company, you have all this technology. You might have spent hundreds of thousands of dollars in creating that tech. And if your trading entity, the one that enters into contracts with its customers, goes pear-shaped, and has a big legal battle, well, the holding company can claw back that intellectual property as well, as long as you have a license agreement between the holding company and trading company. And you'll see in that diagram, it talks about what's PPSR. And I always use an example of if you buy a car and you get finance on your car, the financier has a charge against your vehicle. And what that means is that when they have that charge against your vehicle, if you don't pay your finance, they can come in and repossess your vehicle. Or if you go to try to sell your vehicle, someone that's going to buy the vehicle will see that there's a charge against it. They'll see that the number one secured creditor against that asset is that finance company. Well, you can do the same thing in companies. And the PPSR is that charge that the finance company has against your vehicle, but you can lodge a personal property security registration against another company securing all the company's assets in favor of someone else. So, for instance, if the holding company received $1 million from the investor and then lends money down to the trading company, if you have a loan agreement or a facility agreement and a PPSR registered to secure that loan agreement, then the holding company can then claw back all the money in the bank account or the money that it's lent to it. And same thing with the license of the technology, or if you have machinery, or if you have anything like that that you want to protect the assets, or even your domain name or trademark and things like that. So those are from the asset protection side of things. It gives you great opportunity, but it also gives you great opportunity to grow because if you're a tech company, you're operating one product, you might have one trading company, but if you want to expand out to another, let's say you want to expand to America, well, you don't want your Australian trading company signing off on contracts with American clients because you could end up being hauled into the courts of America. So you would, in those circumstances, create another trading company, which is the American one, so that if the American one gets sued, it's not going to affect your Aussie business. So those are just kind of the flexibility that this kind of structure creates. And we have a bunch of different YouTube videos on this, and those are specified below. But I'll pass it back to you, Tim. I just wanted to
Thank you very
share that.
much.
Yeah.
Thanks, Damon. And yeah, it's a good reminder that it's as with all of these things, the best structure is the simplest one that achieves your objectives. So we might move on to the next slide. So I mean, Damon just dropped the F bomb at the end. Flexibility. Flexibility is all. It's one of the key things in a family trust that makes it so valuable. Certainly from an asset protection perspective, but also as a beautiful side effect as a consequence of this flexibility, this separation of legal ownership and beneficial ownership is that we get the flexibility to distribute the income in a tax effective manner. Now that can mean for as simple as distributing between a couple, a husband and wife, or two partners in that way, in a tax effective way. It can be adult children. We're adding an extra level of complexity. It can be what's called a bucket company or a corporate beneficiary. But the tax benefit of doing this is being able to put on your trustee hat and say, well, I've got six potential people I could give this money to. And there is nothing wrong with me knowing these six people's tax positions before this distribution. So I can decide who can get it in an effective manner. So outside of the asset protection reasons that Damon will talk more to, there are tax side consequences that come out of the side.
Yeah, and I guess the best example I always say, if you're in the high income threshold, let's say you're already receiving a wage either from your business or somewhere else, you're already getting taxed at the highest margin, but your spouse or partner isn't working at all, for instance, well, you might want to distribute some of that distribution to your partner because in those circumstances, you're not going to be getting taxed at the highest tax margin or the tax rate. So, but the main thing also is the asset protection side of things. If you have a startup and the shares are in your own personal name, then any dividends, you're going to be paying your income tax on that. Whereas the dividends would be going to the family trust that can be distributed. But also, if you die or if you get in a car accident or something happens and you're sued, well, you don't own the shares in your business. Your family trust owns the shares in your business, which means the shares and the control of your business is protected because it's a separate entity that holds it. And so that's the benefit as well from the asset protection side of things is you're not the one that's owning the shares. And therefore, if something happens to you, your shares are still protected from bankruptcy, for instance, in many circumstances.
Absolutely. And it's not just good to hold your business, to your trading company and your holding company within these vehicles. It's also a fantastic vehicle to create and build family wealth. So if you own shares or anything like that, or some more passive investments, real estate, for instance, it's a great vehicle to hold all of your wealth and build it. Thanks, Connor. We jump into share capital here. This is it's one of those areas that you do see people taking different approaches to it. Nothing's set in stone. If you have a different looking what we call cap table or list of shareholders that then this it's never set in stone. You can always come back and revisit it. You'll see a lot of people will go out there and register a company with one or two shares at $1. That's perfectly fine when you're in this early growth, early startup stage. But if you will be looking to attract investment, it's not going to give you much flexibility. If you imagine that you've got two shares on issue for $2, it's if you'd like to issue more shares, you're very, very quickly going to give away a large slice of your pie, a large slice of your company. If instead you've set the company up with 10,000 or 100,000 shares at a very nominal cost, it's much easier to issue out a smaller little sliver of shares to an incoming shareholder. So that's why we recommend starting with a higher number of shares. But
Uh,
again,
oh,
it's
sorry,
different
Tim. I
for
was just
everyone.
going to
After
say
you,
also, I was also going to just explain the whole anti-dilution and the dilution of shareholding. A lot of people think, I'll create my company with 1 million shares, and then when invest, and I'm going to calculate that I'm going to hold 600,000, I'm going to give away 400,000. But that's just not how you actually run your cap table or how you run your business, because if you were to have 1 million shares and then take 400,000 and transfer them to your investor, the investor is buying the shares off of you. They're not buying the shares off of the company. And so the money that the investor pays has to go to you, not your company. So you rarely actually transfer shares unless you're selling your business. You actually issue more shares. So if your plan is to own 60% of the business, you got to kind of work backwards and say, okay, well, this is how many I'm going to start with. This is how many I plan on giving on issuing on behalf of the company. But you don't issue shares thinking that these are the ones that we're going to give away, because that's a share transfer. There's capital gains tax that's going to apply to you. It's not how you raise money on behalf of the company, because the money that's going to come in is actually going to go to the person that sold the shares. So that's a fairly standard error that a lot of people make.
That's right. Thanks, Connor. So we talked about this cap table a couple of times. It's very typically an Excel spreadsheet. It's not always the most complicated thing in the world. It basically tells you how many shares you have on issue at the moment. Potentially, you're planning for the next funding round. You might hear things called, Series A, Series B, seed funding rounds. You basically map out your projections, and you keep it as a live document that you adjust as you go. And it's like, as Damon said, you go in with your eyes wide open of, well, how much of my company am I going to be left holding if I need to raise $5 million over 3 rounds? So it's definitely worthwhile investing the time and money up front in building that and building it flexibly and also being realistic. And in that as well, it's probably beyond the scope of this, but we often see other sorts of fundraising mechanisms like safe or convertible notes, or options with vesting periods or employee share schemes. You should always try and capture this in your cap table as well. So if you're issuing out rights to that will convert to shares in the future, you'd have to consider the impact of those conversions to shares in your cap table.
And generally speaking, we can't stress enough that people should get an accountant to help them with this, because it does start becoming very complicated in terms of calculating what is a safe note going to convert at, what's the what how how many options do I issue under an employee share scheme, what or how many shares do I need to maintain this share percentage. And a lot of people go and they just sign off on contracts not having a clue how to actually complete their cap table after they've raised the money, and they don't actually know what the end position is going to be for themselves after they've taken in that investment. So they might say, we'll take $100,000 based on a $2.5 million valuation. Well, what does that actually mean for you when it converts? Um, and just spending some time with the accountant at the beginning to make sure you understand that will save you in the long run from giving away too much of your business, and also helping with the valuation as well. It's really important.
Absolutely. I just cannot stress enough the importance of keeping good records at this time. The number of times I've been involved in very, very painful backtracking through version one, final, version two, draft sets of documents that haven't been signed, where there's a lack of clarity because a lawyer hasn't been consulted, where people have tried with best intentions to go it alone but have deficient record keeping. It's a bit of a nightmare to fix. It's typically involves a lot of ASIC late fees. Anyone that's had the pleasure of dealing with ASIC before, they are not predisposed to waiving penalties on late fees. You can often be hit with quite a big penalty for getting your lodgements and incorrect upfront. So it's a really, really important time to consult with a lawyer and make sure that you have a competent lawyer that's skilled in this and knows, first of all, which records need to be kept. And second of all, is a bit of a stickler for the rules in making sure they get them all signed.
Yeah, and ASICs increase their fees significantly. So it's $400 if you don't lodge your changes with ASIC within 28 days. And it compounds, I think, $400 a month ongoing. So I've seen people having to pay $13,000 to ASIC just because they incorporated their company wrong. They might say they meant to have the shares held on behalf of the trust, but they put it as held in their own personal capacity. And then they find out years later that they made an error and they have to go back and pay ASIC fees for making those changes. And I have another one where someone's gone and just entered into a convertible note, which is money like a convertible loan where they take in $100,000 and then that lender can convert the money into shares later. Well, that's what's called a security. It's an option to effectively buy shares later. And if you don't have a shareholders agreement, it's under Section 254 of the Corporations Act. It says that you can't issue securities in your business without first offering those securities to your existing shareholders. So if you go and enter into this kind of arrangement and don't get consent from your shareholders and don't offer your existing shareholders the same kind of offer, you can get yourself into a lot of problems. And that falls into Section 233 and 232 of the Corporations Act, which is oppressive conduct and acting in a manner that's discriminatory to other shareholders. So it's really important that you check the boxes, you get your director's approval, you get your shareholders' approval where required. You have a shareholders agreement that can possibly contract out of Section 254 of the Corporations Act. But these are all things that we do as lawyers when it comes time to capital raise. It's you don't have any documentation. We've got to go back and get the director approval and the shareholder approval and update ASIC and do all that stuff. And that can take a long time to fix, and it can result in fines from ASIC. So staying on top of it and doing all your paperwork for each transaction that you do is really important. And it helps when it comes down to capital raising because you're going to get due diligence done on you and you have to have everything in order.
Absolutely. ESIC. This is a nice fun one. Not ASIC, ESIC. Very confusing, I know. These are the early stage innovation company tax offsets. These are very, very juicy ones too. They're a nice tax offset, not just a deduction. That can mean drastically cutting your tax bill. It can, if you imagine that you would have put in the nice example here is $200,000 as an investor into one of these innovative early stage companies. You can receive a 20% what's called a non-refundable tax offset. So you could bring down your tax bill quite significantly by $40,000 in that instance. More so than that, there's not only the upfront juicy bit of that tax concession, there is also an exemption on capital gains tax. So if you hold your shares in this eligible early stage innovation company for between 1 and 10 years, and you then sell it, hopefully for an enormous profit, that profit, which would normally be hit with capital gains tax, is CGT or capital gains tax free. So it's definitely worth looking into. It's not for your first founding investors. It's for basically the next round of investors who will tip in. So typically, it's a very attractive thing for companies that are looking for their first round of investors. Going out there to friends and family or angel investors, getting a small but reasonably sized chunk below 30% of a company and it can be a very, very attractive investment opportunity for them.
And I guess it just gives your business one edge up. Um, it's very, very competitive. It might not convince someone to invest in your business, but if they're looking at two different opportunities, and one opportunity is no capital gains tax, then they'll probably go with that one. So it just gives
Absolutely.
it that. And it
Yeah.
also shows that you know what you're doing. Um, and it gives a little bit more confidence to the investor saying, well, they know what they're doing because they've gone and done this.
Yeah,
And
absolutely.
they're there to help out the investors.
And again, it is an area where you should always get certainly some professional advice as to whether you qualify. There are a couple of ways of qualifying. There's a points-based test and a principles-based test. Just always talk to an accountant that's experienced in these areas because you wouldn't want to go out offering tax incentives that don't exist. So just be wary of that. We move forward. ESOP, I touched on this very, very quickly earlier. We call them ESS in the Australian tax law, but it is often referred to as an ESOP colloquially and certainly overseas as well. These are basically employee share schemes or employee share option schemes. Whatever you call them and whatever flavor they come in, it's about giving your employees, typically your key employees, access to your equity, a bit of exposure to it. Now, why would you want to do this? If you're out there starting up a new company and seeking investment, you feel like you're already giving away bits of your company. Well, the idea is that you align your key employees' objectives and align their performance with the company's. There's nothing more real than looking on a shareholder register and seeing your name, and that as an employee, you are both responsible for and exposed to the benefit of the company doing well. So you typically see 8, 10, perhaps 15%, not generally much higher than that, where you'll set aside for your company. You wouldn't give it away day one. You might give away 1 or 2% here or there and keep some in reserve. These schemes are fantastic. They will typically vest, and when we say vest, is your employee won't get the full allotment of shares day one. It'll typically be often a 12-month cliff, so they'll get nothing for the first year, and then they'll get a certain percentage every year for 4 years, maybe subject to performance hurdles as well. So you can put in criteria linked to revenue, linked to profitability, linked to sales, and anything you want really, anything you can reliably put in a shareholders agreement or in a set of ESOP plan rules. There are, as I mentioned, different flavors of ESS, but there's a particularly good one in Australia for startups. It's called the ESS Startup Tax Concessional Scheme, where there are discounts and protections from getting taxed up front for nothing, for no benefit down the line. So there's a way of deferring the taxing point and reducing the amount of tax you will pay until you eventually make a profit. And if you don't, then you won't pay any tax. So that's typically the way that we see lots of people structure these things. I think Lawpath itself is now past 10 years, which makes it no longer eligible for the startup concession. In these scenarios where you're approaching or past 10 years, there are certainly lots of good other options out there to look for. And accountants and lawyers that deal with startups will be able to explain them and recommend the best one for you because there is no one size fits all ESOP. It's always worth making sure that you've really thought about your commercial objectives. Let the tax consequences come from that. I always think it's more important to consider the commercial side of what you're trying to achieve. Let us worry about how to structure it right for tax reasons.
And I guess the main thing that we see all the time is just people not getting advice on it and just stuffing it up completely in the sense that they might put in an employment contract. You're normally on a $180,000 salary as a big top shot CTO, but we're only going to pay you 120,000 and we're going to give you $60,000 worth of shares. Well, because of the way that you drafted it, that will be deemed income. And then they get slammed with income tax on income that they're actually not receiving just because of the way that they've drafted the contract. If they had just said, you're going to get 120 and then give a separate letter of offer saying, and you get to participate in our share option plan, um, then there wouldn't have been an income tax effect. But it's just the wording where you just got to get it right to protect yourself.
Absolutely. There's nothing worse than getting a taxable bit of paper that never actually converts into anything valuable.
Yeah.
moving on, we're looking at budgeting. It's one of those things that I'm always surprised a lot of small business owners do neglect. And typically, you you often see it happen. What's the polite way of saying this? In the wrong order of things, down the line where it should be front of mind. It doesn't have to be the world's most complicated document. It doesn't need to be an incredibly complicated linked Excel file or anything like that. But you should know the basics of what are you trying to achieve with your business? What are your objectives? How much are you going to sell? How much do you think you can sell? How much is it going to cost you to produce? A lot of these things you might think just by observing other businesses that they just happen, but they don't. You actually do need to have a conscious thought about how are you going to offer your product out to the market, whatever product that is. It might be the sort of product that has no revenue early days. We see plenty of startups here at Lawpath. That's not fatal, but you certainly need to know what we call your runway. When are you going to start running out of cash? When are you going to need to go out, cap in hand to your shareholders and or to some potential lenders and say, can I have some money, please? So you really do need to consciously set aside some time. The best time to do it is before you've started your business, and the next best time is now. So if you have been putting it off, please come and talk to us. We're very happy to talk you through it. It doesn't have to be painful, but it does need to be done. Thank you, Connor. Ah, end of financial year, end of calendar year. Any time's a good time to set up your budget and your forecast. And your budget is not something that sits at the bottom of your drawer and collects dust. Your budget is something that you can and must adapt as things change. You got to allow for your taxes. You'll be shocked at the number of big companies that don't allow for things like GST, a big quarterly or perhaps monthly obligation that is going to be an incredible cash drain on you, certainly in your early days. Please don't forget about them. Look, you got to use your historical transactions. If you know that you did a budget last year and you ended up falling short of that budget projection because you hadn't factored something in, please don't let it roll over into the next year. Make sure that you do adapt that budget accordingly based on what you've learned. Look, use benchmarks where possible. Certainly, there'll be different benchmarks for different industries. There's plenty of businesses and business brokers that are out there that publish these things these days. So you can get a sense of what other companies are doing. Don't think you have to do it completely from scratch. Do factor in things like, are you going to need new people? You might be factoring in that your sales will double or triple next year. Fantastic. Good for you. Are you going to need to have some more employees to cover the cost of doing that? Is the shipping cost going to increase? Please do just bear these things in mind. The chance to actually look at your budget is a chance to look at your subscriptions and things like that that can creep up. It's a good opportunity to take a razor to things that you're potentially not using and cut things out. And that's all I've really got to say on budgeting. Again, it's something that you as a business owner should take ownership of, but it's something that you should definitely get input from your professional support services from as well. Don't try and go it alone. Expansion. This is what we call scaling up. Often you'll hear it referred to as scaling up or expansion. You might have reached a point where your business is bursting at the seams for a good reason. You might have good problems to have. There might be a reason for you to set up a new company. Your existing company that has served you well might be starting to show some signs of legal stress. If you're running two very separate operations within a company, we always see that as a bit of a red flag sometimes because you don't like to mix your assets, your good things with your risks and your liabilities. So it can be an opportunity to think about splitting out into a new company, or if you've got this model of the holding company and the operating, maybe it's time to start replicating that model out a little bit. How complex is your finance function? Xero is fantastic. All these cloud-based accounting programs are fantastic, but it is very much only as good as you make it, and it can be garbage in, garbage out too. So, have you got enough tracking built into it? Are you using it to the utmost of its capabilities to track things? Are you looking at things like different projects? Have you got project accounting built in? Xero's great at that. You can do it very easily. Have you thought about your funding? Debt versus equity is a huge one. There's been this influx of lenders into startups. They love to call it non-dilutive fundraising, which is a nice way of saying we'll just charge you interest instead of making you give away your company. It can be fantastic for a growing business. Debt doesn't need to be thought of as a terrifying, scary thing. It's not something you enter into lightly, but if you can see that your company is growing and growing profitably, you might prefer to take on a bit of debt to fund that rather than giving away more of your company. Again, any part of your expansion, you must be thinking marketing and sales. You just can't expect it to happen. You've got a plan for it to happen. Other points there, we've mentioned the finance function. Do you need a little bit more hands-on expertise? Do you need a CFO who's perhaps skilled at more complex matters or skilled at raising capital? Are you using things like the R&D tax incentive? That's a great one. EMDG, less good these days, almost more complicated than it's worth. But make sure that you are looking at these different grant programs out there. And Connor, I might go forward,
I was just going to touch about
please.
debt as well. A lot of people are afraid of debt, but some of the schemes that they have out there now are really great. Like for instance, if you're developing software, you don't have that much revenue. Um, you're going to rely heavily on your R&D tax incentive, and there's companies out there that will lend you more money so you can spend more money on your R&D, and they'll just secure as a security your refund. So you can actually borrow money to do R&D, even though you're not necessarily making that much profit. And the other one is if you have a software that has, an ARR, an annualized recurring revenue, there's companies out there that will lend you based on what your subscription base is. So if you have $300,000 projected annual recurring income, people will lend money just based on that and secure it against your subscriptions. So there's a lot, it's not just simply a loan, there's other really interesting debt options out there that can be really great.
Absolutely. Finance function, that's a nice way of saying your team of bookkeepers and accountants. Often your finance function when you're starting up a business is you. It's just you as a shareholder and you as a director. You're trying to do it alone. That's fine. A lot of these things have a pretty good learning curve where you can do enough to keep yourself out of trouble, or sometimes do enough to get yourself into some trouble if you're flying by the seat of your pants a little bit. As you grow and as you expand, your finance function will grow in complexity. You might have people that are just dedicated to what we call accounts receivable or chasing up your debtors. There's nothing worse than having a great profitable business that can't collect money fast enough to pay its outgoings. If you imagine a nice, simple sounding business which has income from customers and pays its employees, well, you better be damn sure you're paying your employees on time, but you can't always have that level of security and safety that you'll actually get paid on time. So a lot of small businesses will be really hamstrung by this. A lot of small businesses that deal with really big businesses would be shocked to learn how slow these big businesses are to pay. Not naming any names, but I've had some clients dealing with some of the largest companies in the world who have 90-day trading terms or 60-day trading terms. And then they push that to the nth degree as well. I mean, you can be sitting with no cash coming in for months. So having a finance function that's complicated enough to factor this in, you can't just look at a profit and loss. You've got to think cash. Cash is king. Making sure that you've got someone that's across your records and that is you've basically got a team of people out there to cover everything you need is going to be much more beneficial for you as you're growing than trying to do it alone.
And I guess one thing also is if you are going to take on a big contract like a government or someone like that that has 90-day payment terms or 60-day payment terms, before you take on that contract, it might be a good idea to get a line of credit. If you have sufficient cash flow there, you can get a line of credit to give you that buffer in the event that that big corporate um, isn't paying you on time. So there's different things to think about before you take on big projects. And it's normally the big projects that really bring down smaller companies because they don't have their systems in place. to protect themselves in the event that the big guy decides to terminate the contract or doesn't pay the last invoice. And it's just making sure you have everything in order to protect yourself if something goes bad.
That's right. Tax considerations, the most important things on everyone's mind, obviously. Look, the reality is, as you grow, you will start to expose yourself to new and interesting taxes, new and painful taxes quite often. If I'm thinking about the first one on this list, which is fringe benefits tax or FBT, this is any time you're giving a benefit to an employee that isn't cash. So often you'll hear people in different countries talking about getting health insurance from their employer. In Australia, that would be a very, very bad idea because it's actually taxed at a higher rate than if you're receiving cash. The ATO does not particularly like you providing fringe benefits. Why? Because it's hard for them to track. They can track how much cash you're getting really, really easily. They've got plenty of systems in place to check if you're paying enough tax on your employment income. It's harder to tax a thing. So they say, well, if you are going to provide a thing, a fringe benefit to your employees, we're going to tax it to the nth degree. Common fringe benefits you do see are things that you might not even think about. Providing meals and entertainment to employees can see you caught there beyond very basic, provision of sandwiches and coffee at a meeting. Anytime you're taking your employees out, you've got to have a second thought. There are exemptions out there, but it can be very much more complicated than you'd expect, and it's just another compliance cost as well, having to register for FBT, having to report FBT, which for some reason does not align with the June financial year. No one can tell me why, but it's there. A lot of these taxes get more complicated than you'd expect. Payroll tax, you might think you're already paying payroll tax. You probably aren't. You're probably paying PAYGW, which is the tax that we pay on, as all employees do, to the federal government. Payroll tax is a state by state issue. So if you operate in lots of states, good for you. You're going to have a very complicated payroll tax report. You'll have to start reporting more often to the ATO. Often, as companies scale up, they will move from an annual or from a quarterly cycle to monthly, to even weekly if you're up as a high withholding payer of employees. It can be very complicated. When you are looking to grow, or you might have some capital gains tax issues if you're looking to restructure. There are concessions for these, but they don't happen automatically. They are complicated and require some thought. Often at this point of time, as your companies grow, you might start withdrawing money. You might start taking loans from the company if the money is there. It's something that I would never advise doing without discussing with your lawyer and without having a plan for how you're going to repay that loan. Because if you don't, what's called the Div 7A will start to step in and start to impose some interest and penalties on you, basically for either not paying it or not paying a sufficient amount back of that loan every year. And just very quickly, the family trusts, which are still incredibly useful, have become a little bit more complicated, a little bit more work for your accountants to deal with the recent. It's not. Was going to say changes to 100A, but it's actually just a new interpretation of 100A. It's really aimed at stopping the use by adult children of family trusted distributions as much as they used to. It's just something to bear in mind. And I think we might be over to Damin to talk legal.
Thank you. I'm going to run through this fairly quickly, and hopefully we'll have some time to answer any questions. So we do have that Q&A section. You'll see, please drop in any questions for Tim or I. But what we're going to do is we're just going to roll through mostly some recent updates to the law, just so that you know that they're out there. So the first one is we had changes to the Australian consumer law, and that resulted in the ACCC pursuing more people, mostly bigger companies, for what's called unfair contract terms. And those contract terms are now becoming more prevalent in terms of people challenging those terms. And the main ones is an unfair contract is effectively where it's not balanced between the parties and there's no legitimate business interest as why it shouldn't be balanced. So for instance, if you have a limited liability in for one party and not the other, or indemnity for one party and not the other, or if one party can terminate for these reasons, but the other party can't, or if you have an automatic renewal clause that's not clear and specific, or if you have a subscription-based model where um, people pay on an annual basis, but then if they terminate early, they don't get their money back, or if they sign up to a 2-year contract and they want to get out early, then they have to pay the entire 2 years. These can be deemed penalties that can be deemed unfair contract terms. And enforcing an unfair contract term, there's clauses in the Australian consumer law and the Competition Consumer Act where they can actually pursue directors personally for trying to enforce these unfair contracts. So it used to be the day where you'd have online website terms and conditions and you'd say, I can put whatever I want in these because no one's actually ever going to read them. It's not really that anymore, because if you do have unfair contract terms in it and then you try to enforce it, you as a director can be personally liable. So revisit your termination clauses, revisit your automatic renewal clauses, revisit your indemnity and your limited liability. You can't just say I'm not liable for anything. That's called an exclusion clause. There's automatically guarantees under the Australian consumer law in relation to goods and services. Um, that services are going to be delivered within a reasonable period of time. For goods, it's a merchantable quality, fit for purpose, things like that. So make sure that your terms aren't going to fall foul to the unfair contract terms. You can look up Section 26 of the Australian Consumer Law. It gives examples of what an unfair, unjust contract term is. So we were talking before about your budgeting and things like that, and if you sign up to a big company, whether they're going to pay you or not. Generally speaking, the main reason why you don't get paid for an invoice is probably because there's a lack of communication between you and your customer. A lot of times people will include what is included in the services, but they don't put what's excluded from the services. And, in your mind, you might say, this is what you get. But in their mind, they might think there's something completely different. And if you don't have a meeting of the minds where where it's ambiguous about what is and is not included, then that's where you get the dispute. So it's really important to be very, very specific about what is included, what's not included. You might have a contract that says, I'm going to go do a business with someone in New York, and Australian law applies. And if there's a dispute, the dispute's held in Melbourne. Well, that's not going to be very good for you because if your client in New York doesn't have any assets in Australia, then you can sue them here in Australia. You could get judgment against them here in Australia, but you have no assets to actually enforce that judgment against. And we don't have a mutual recognition of judgments with the United States. So generally speaking, if you're doing business internationally, you want to have an arbitration clause. And the reason for that is we have something called the New York Convention from 1958. And that says that there's 152 countries around the world that have signed up to this international convention. And it says if you have an arbitration clause, people can choose what the applicable law is. They can also choose a contract out of court and resolve it by way of arbitration, which is effectively appointing a third party to resolve your dispute. And if that arbitrator makes a decision, which is called an arbitration award, then that arbitration award is binding against the parties in all 152 countries around the world. And then you can then take that arbitration decision, which might be from a dispute center in Australia under Australian law in Melbourne, but you can still take that decision and have it stamped as a judgment in New York. So it is quite powerful, and it's something to consider if you're doing international business. Have a look at warranties. Generally speaking, under Australian consumer law, you have to have warranties. They're automatically guaranteed. So if you have contracts that say you're not having any warranties, then it might be unenforceable. Have a look at some of the other things. So a lot of times if you're just starting out, people will go and they'll incorporate a company. They'll get really excited because they got the exact company name that they wanted, or they might get a domain name and it's exactly what they wanted. But that doesn't protect your intellectual property. And the reason why it doesn't protect your intellectual property is because if you have a trademark or a brand or a name, the only thing that's really going to protect it is a trademark. So you have just because you've got a company, let's say Lawpath Pty Ltd, doesn't mean someone else can create Lawpath Operations or Lawpath Services or Lawpath Number Two or Lawpath Corporation. Uh, just because you have a company name doesn't protect your brand. So consider getting a trademark. And also just remember a contractor, if they do anything for your business, they own their own IP. You don't own it. It's only the work that an employee does that's owned by your business. So if you're hiring a contractor, make sure you have a really good intellectual property clause. Um, and those are basically some of the things just to consider about being protected. And finally, there's no reason to say that you're in your invoice terms 30 days. There's no rule of thumb saying 30 days. We always say reduce that down to 14 or possibly 10 or even 7 because you're not going to find out until someone doesn't pay you. So if you have 30-day terms and you issue it on the 30th of the month, you don't find out until after providing another full month of services that they're not going to pay you. And now you're down 2 months of not getting paid. So shorten the period for payment terms because there's no need to give 30 days. Connor, next slide. Um, Now, having a look at actual contracts themselves, make sure you look at the indemnity, the warranties, the general disclaimers, the limited liability, and the termination clause. The termination clause is really, really important. A lot of times people just brush over it. If you don't have a termination clause, you can't terminate the contract. You might want to terminate the contract on the customer, but if you don't have a right to do so, you can't. And so if you then go and try to terminate the contract, you're doing it wrongfully. And if you do a contract wrongfully, someone can sue you for breach of contract and then sue you for damages or seek specific performance forcing you to comply with the terms. A couple other things to look at is a lot of times you'll say, this is what I'm going to do, but it doesn't say what they're going to do. Normally, you want to have obligations flowing both ways. I'm going to go and develop your website. So I'm going to do this, 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 this. But you need a positive obligation from your customer saying, I'll give directions, I'll give authorization, I'll give the documents that you need, I'll give you your approvals that you need within a reasonable period of time or within 3 business days or whatever it is. Because if you don't get those approvals and so on, you can't actually move on. Or if you don't get the approvals and you do move on, you can now be in breach of the contract because they say they didn't agree to that. So just have a look at those kind of things. Make sure you have obligations flowing both ways and not just one way. Now I'm going to flick through this really quick. So Connor, just keep your finger on the pulse here. So employment updates, we have flexible working arrangements that came in last year. So it used to be that only if you were in certain circumstances were you allowed to have an employee request for flexible work arrangements. Now applies to any employee who can make a request. And there's now a positive obligation on the employer to respond to that request and only to refuse it under situations which are reasonable. And so that just know that if someone does make a request for a flexible work arrangement, pick up my kids, drop off my kids, work from home on these days, you have to consider it. You have to respond to it, and you have to come up with a sufficient reason why you're not going to approve it. They go back one slide. Nope, go forward one slide. Probation on fixed term contracts. It used to be that people would sign people up for a 1-year contract and then just every year give them another contract and another contract and another contract and say, oh, well, you're on a fixed term contract, so you can't bring an unfair dismissal. Well, they've changed the law. Whereas if you're going to give someone a 1-year contract and another one again, once you go into 2 years, they're deemed a permanent employee. So they will have the right to an unfair dismissal claim. So 1-year contracts don't really add much value to you to protect you from the general unfair dismissal claims that are available. Next slide. The working relationship test, they've changed the law. So the High Court came down with 2 decisions. It said that originally, when looking at whether someone is a contractor or an employee, first step is we look at the contract. Let's say it's a contractor's agreement. It says that the contractor is going to work for the business. They're going to issue invoices, and then they look at what the terms of the contract are, and then they consider about 16 different factors as to whether they are an employee or a contractor. And then the High Court came back down with their final decision saying, yes, we do give credence to the terms of the contract. If you hire a contractor, they agree to be a contractor, they sign a contractor agreement, they're more likely going to be a contractor. But we'll still look at how much control you have over them, whether they get to choose their own hours, whether they're allowed to delegate the work, whether they bring their own tools of trade, things like that. But the contract still has prominence. The government didn't like that. So the government changed the law. The government changed the law to go against these high court decisions, which basically says, no, we don't give credence to that contract. We look at the whole relationship test. We look at what the actual relationship is to determine whether they are an employer or contractor. So if you are hiring someone as a contractor simply to get around award wages or award modern award terms and conditions, then be very, very careful that that contractor could be deemed an employee. And you should only be hiring a contractor in a true contractor situation where it's on a project based, whether it's on a specific task. But if you're hiring someone just to get around, minimum wages or the award rates or the minimum shift requirements or anything like that, you will likely fall foul, and it is very, very possible that your contractor will be deemed an employee. People probably heard this on the news, right to disconnect. An employee gets text message, phone calls, emails after hours. They have a right not to respond to them till the next day, unless it's in exceptional circumstances. We also have some laws that are coming in right now. So today, or not today, on the 1st. So the next slide is same job, same pay, which is essentially if you're a labor hire business, you place employees into other businesses. If you're doing that for another business, and the reason you're doing that is because that business doesn't want to pay this employee the same as them or that of their own employees, or comply with the modern war or the enterprise agreement that might apply to their actual employees, then the whole framework of labor hire can be overlooked. And just because they're being contracted by another company, like a labor hire business, into the other company, that person being contracted in is entitled to the same job, same pay, same entitlements. Unfair contract terms, which I mentioned, but now the Fair Work Commission has powers to look at employment contracts and read down unfair contract terms in employment contracts. And that's it. So we'll jump over to Connor, and then we'll jump into the Q&A if you have any questions.
Thanks, Damin, and thanks, Tim, for your presentation and slides there. Just a quick 5 minutes before we jump into the Q&A. So if you do have any questions in relation to this webinar, or perhaps an unrelated question, but it's in relation to your business, please feel free to drop that in the Q&A now. I do want to provide a quick overview of how Lawpath can help in a broader sense. First things first. We are offering very early our Black Friday offer just to people on the webinar today. So very simply, it's 40% off on across our bundles, but also now across our standalone legal and accounting plans, including on our quarterly options. So this is the coupon code which you can apply at the checkout to claim. It will only work for our annual plan, so please let me know if you do need it set up on our quarterly installment option. And I've talked a lot about early on the seniority of our lawyers and accountants, but we want to still provide this access at a cost affordable to startups. So we have their unlimited consultations and unlimited on-call contract reviews with our lawyers, and/or unlimited consultations with our accountants for this price here, which is incredible value, especially when you factor in, senior lawyers and accountants bill between $500 to $700 for an hour of their time. But also, if you are actually bundling up the subscription, including the essentials, we do throw in that 500 legal documents, which are all drafted by a team of commercial lawyers. They're all up to date with Australian legislation, including, as mentioned in today's webinar, the shareholders agreement, which if you were to go get drafted at a basic level by a lawyer, would cost you in the ballpark, I think, of about 2 to 3 grand at a basic level. So, on top of that as well, these subscriptions are classed as a digital business expense by the ATO. So, any purchase with us is 100% tax deductible. And the slides from today, I would take advantage of speaking to our legal and accounting team to do a deeper dive on any of the topics you saw and just hear how it relates to your business. But a few of the hot topics you can also discuss, whether it's through the legal advice plan or the accounting advice plan, some of which we've mentioned. So, your business structure and asset protection, employment and contractor law compliance, contract management of your commercial agreements, tax planning and compliance, capital raising and investment, risk management and liability, your intellectual property protection, dispute resolution. We also focus on privacy and data protection. And finally, as a bit of a top 10, business success, succession, business sale, succession, and exit planning. So if that is actually of interest to anyone, please reply yes in the chat. Someone can reach out to you to discuss further if you do have questions, and also even run a demo of the platform so you can actually see it from a subscriber's perspective. I've got on here our top selling bundle. It's actually our legal advice, accounting advice, and tax. So it is the most expensive, but just because of the sheer crossover of topics, and the advantages of having, lawyers on hand, your accountants on hand, and then that hands-on work with the tax plan there, it is just the best value bundle that we have on Lawpath. What we typically do is we start with a discovery call so we can understand your business as much as possible in as much detail as possible, deal with any roadblocks you're currently experiencing, address the legal and accounting gaps within your business that you're not aware of, as you don't know what you don't know, recommend documents you need for your business, and finally, as we've kind of touched on in today's webinar, lay out next steps for your business, this side of the calendar year and the financial year going forward. If you are still unsure, I'll just flick through these quickly of where to go from there. We do include these accelerator programs for both the legal and accounting. They're designed basically to get bang for your buck for your subscription and to ensure that within a year's time, you have a very strong, foundational understanding of the legal and accounting aspects of your business. So, they're all about building your business with brick and mortar and not sand.